Hello and welcome to this Monday's weekly market briefing. We've got lots to talk about, but firstly, the Fed remains confident about cutting interest rates, and this is despite a jobs surge. As well as that, Trump says Russia can do what it wants to NATO allies who pay too little. As well as that, US lenders' debt to shadow banks passes the $1 trillion figure. We've got lots to talk about in the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. But the first article to talk about is in relation to the Fed. Now, despite a recent surge in jobs growth in the US, the Fed is still set to cut interest rates with fewer job vacancies, convincing officials that the current status of the labour market won't trigger inflation. Now, of course, recently we've very much been talking about the US's job market as well as, of course, the Fed's monetary policy. And this is because, of course, both of those are so interlinked, and the Fed does depend greatly on data from the US jobs market to make their decisions in regards to US monetary policy. And generally, we look to see whether the market, the labour market, is tight or loose or that kind of thing, to kind of gauge how the Fed may think about things. Now, of course, since about October, November of last year, we've seen the Fed take a more dovish stance on its monetary policy, with investors then moving towards looking at when interest rates are going to come down rather than when they're going to go up further. And therefore, investors have been pricing in since October, since November of last year, when the Fed will start cutting rates. And of course, the earliest sort of figures we were talking about maybe last month was, in the March kind of region. Of course, we're now nearing that kind of time, and it doesn't seem like the Fed will cut interest rates that soon. And this is, something that's kind of, become more important recently, of course, since we got the Fed, since we got the US NFP figure nearly a week ago now, more than a week ago now, on Friday, where we did see, in fact, that more US jobs had been added to payroll than previously expected. And it was double the figure that economists had previously predicted. And what might this, represent in regards to the US and the Fed is, a more hawkish monetary policy as a result of, more individuals being added to payroll, creating this kind of fear in regards to inflationary pressure. And that was the key thing to note last week. And that's why we were starting to talk about, maybe interest rates won't start being cut in March. And in fact, we're going to have to push back that date quite significantly. And this was followed up, of course, by a very important Fed official, Catherine Mann, of course, commenting on the situation by basically saying that, interest rates should actually go up further. And she was one of the two she was one of the two Fed officials which actually did vote for increased interest rates in the last meeting. Now, one Fed official did vote for interest rates to be cut. However, two voted for an increase, and she was one of them. And she justified that basically on the point of, services prices are still growing and that kind of thing. Actually, no, I think I've got very, very confused there, sorry. And I think I was talking about the Bank of England there. What I did mean to say, though, however, is, of course, that NFP figure. So not talking about Catherine Mann. That was in reference to the Bank of England, sorry. But ultimately, it's still important to note how the NFP figure that we did receive, over a week ago now, did kind of reinforce this kind of skeptical view of some that basically, we're not seeing the we're not seeing inflation drop to the levels that we're actually looking it to drop to before we can start talking about interest rate cuts, basically. And so it's very important to understand that when we're looking at markets, is that, ultimately there is still a great deal of inflationary pressure within the US. And, whilst I did kind of joke about, talking about the wrong official there with Catherine Mann from the Bank of England, while she is from, of course, the UK and was talking about inflation in the UK, ultimately the risks that she kind of spoke about also opposed to the US and the ECB, the Eurozone, and those risks are associated with world tensions and issues within the Middle East. Of course, as we've spoken about many times, regional conflicts within the Middle East could cause oil prices to skyrocket and heavily damage, the Middle Eastern kind of oil supply, and as a result, largely affect European and the US oil market basically, and as a result create a great deal of inflation. So it's not like there's no inflationary pressures left within the US economy, and that's the key thing to note. But ultimately what we're now hearing here is kind of a counter point on the issue of inflation, with the Fed remaining confident about cutting those interest rates. Now, this all comes, of course, following the NFP figure a week ago on Friday, which showed that the US economy had added 353,000 jobs in January, which sent hawkish shockwaves through the markets. And as a result of that figure, of course, we did see the dollar move significantly to the upside. Now, despite this data, however, it seems that officials are comfortable with the trajectory for rate cuts this year, with inflation likely to fall even if new jobs are added to the US economy. The US jobs market has puzzled Fed officials following rate hikes, since most expected the US job market to take a hit following higher rates. However, unemployment has stayed at a low level of 3.7%, and that's been a key kind of point of discussion recently, is in fact how the US economy has actually coped extremely well considering the interest rate hikes. Because if we just look to the UK or the Eurozone, those interest rate increases that we have seen have heavily damaged the economies of the UK and the Eurozone as a whole, and of course stagnations in key industries and a great deal of growth being stunted basically as a result of those higher interest rates. On the other hand, the US economy has continued to grow and has kind of remained this beacon of light within the global economy. And so ultimately, this has kind of puzzled many Fed policy makers who might usually expect unemployment to go up if interest rates do go up as a result of that, hurting businesses laying off workers and that kind of thing. Now, the Fed is expecting the labour market will cool this year, but a rise in unemployment isn't necessary in order to bring inflation to the 2% goal set by the Fed. A large reason why the wage growth and thus price growth is being contained is due to a large influx of foreign workers that have entered the US, with the impact of the post-pandemic wave of migrants being a positive to the US's economy. The influx of workers has, as a result, helped lower labor costs and thus restricted price growth. So this is very important to note in regards to the Fed, and is very, very important indeed. So keep your eyes on the US's labour market as well as any Fed decisions as well. That's all to talk about on this article. Next article to talk about is in regards to Trump, where we are hearing Trump's rhetoric return to our screens in regards to NATO and other European alliances and that kind of thing. Now, on Saturday, Trump stated that he warned NATO allies that he would let Russia do what they wanted to European NATO allies if they failed to meet NATO spending targets. NATO Secretary General, however, responded saying the alliance remained ready to defend all allies. Now, this is kind of returning to that 2016 to 2020 rhetoric that we were hearing from Trump in regards to NATO and, even other kind of European cooperation alliances and that kind of thing, like even the EU or something like that, because ultimately Trump has always kind of warned NATO and other regional allies within NATO about their spending, as ultimately the US do make up a large deal of spending within NATO and far exceed most others in regards to percentage of GDP spending. And that's where it really comes down to in relation to NATO, is whether you're hitting your 2% of GDP being spent on defense target, and ultimately most nations within NATO aren't reaching that. To say a few, we've got Germany, we've got France, Czech Republic, Norway. All of these nations, basically, according to Trump, would be let to die, basically, against Russia should Russia invade those nations or attack those nations in any way, because ultimately they're not hitting those spending targets. And while some people might say this is Trump hating NATO or being anti-NATO, ultimately at some point you also have to kind of look at this as a way that Trump once again resorts to his unorthodox ways of persuading allies and regional allies, as ultimately this could push certain allies within NATO over the border and force them to basically up their spending to make sure that they're not slacking behind, because a key point of Trump has so far been that we need to keep our eyes on our spending, and this is despite of course his record high spending under his own presidency. But ultimately his key rhetoric is around everyone maintaining their fair share, and the US can't be kind of just used as a money pit for most nations. So that's the key thing to note from this. Now, these comments came in the lead up to the Republican primary in South Carolina in Feb. Should Trump go on to win this primary, he'll be in a significant position to beat Joe Biden in the November elections. Trump has long been a NATO skeptic and has said that NATO was busted until he came into power. According to Trump, when a NATO ally asked whether the US would defend it should Russia invade, Trump said he would encourage Russia to do whatever the hell they want, and if you have to pay, you've got to pay your bills. So basically saying, they need to pay up if they want to kind of actually be a part of this alliance and be protected, basically. Now, these comments signal the possibility that if Trump is re-elected, he may threaten the commitment to mutual defense, which the NATO alliance obviously finds so important. With this being a specifically worrying notion at a time where Russia is invading Ukraine actively. That's all to talk about in this article, though. Keep your eyes on it in regards to world tensions. Next to talk about is US lenders. Now, US financial institutions have now loaned to shadow banks over $1 trillion. Shadow banks include the likes of fintech and private credit groups. However, regulators have warned that this is strengthening ties between differing lenders and therefore could present systemic risks. According to the FT, hedge funds, private equity firms, direct lenders, and others use the money to leverage investments and increasingly lend out to a range of risky borrowers that regulators have discouraged banks from lending to directly. With the figure of such lending up 12% in the past year, all bank loans in comparison is only up 2% growth-wise. There is very little information or oversight in regards to risks being taken by shadow banks, which is why regulators are so worried about its growth. Now, large financial institutions are increasingly buddying up with these shadow banks. For example, Citigroup recently stated that it was to be partnering up with the investment manager Lumin Arcs for a new loan fund, as well as other names such as Wells Fargo and JP Morgan doing all the same. So this is a very, very important thing to keep your eyes on. Of course, within the last 2 years, 3 years, we have seen a great deal of issues in relation to lending and, certain banks going under. And so all these kind of tidbits of information in regards to lending within the US capital markets and US financial institutions is so important to understand, as these are what make up, the future financial crises, basically. So understanding them is so important. That's all to talk about in this article, though. We've covered lots in the articles. Next to talk about, of course, is the economic calendar, where we do have quite a bit to talk about. And we are starting, of course, on US indices as a whole, and in particular, the US 30, so the Dow Jones. Now, the US 30 is in a very interesting position after it stalled out after making new highs as we did end off the new week. Now, throughout last week, we continually spoke about this key area of liquidity and resistance at the highs of the US 30, and price had retraced down and made its way back up to that area. And we did speak about whether the US 30 was going to push through it, break through it, and push to the upside, or in fact was going to react to that level and sell off as a result. And what we've kind of seen as a result of the area being a key area of resistance, but also having a great deal of buy side momentum, is kind of a mix of both. And we've seen price break above those all-time highs, and spike above, but ultimately sell off as a result of making those new highs. And is now once again kind of within that area of liquidity and resistance. Now, this is a very interesting area, of course, as we enter the new week. We could definitely see a short sell-off to the downside, a bit of a retracement before a push to the upside following that. So, definitely keep your eyes on the US 30. It's in a very interesting level. And if we do break above this all-time liquidity, level and all-time high, ultimately we could see price making its way all the way up to that minus 27.2% Fibonacci extension level. So definitely keep your eyes on the US 30. It's in a very interesting position indeed. Next to talk about though is the dollar. Of course, we just spoke about the news in relation to the Fed, and what we did hear from that article is something that kind of brought us back to the more dovish rhetoric that we've been hearing up until the NFP figure that we did receive nearly a week ago. So this could definitely bring back some sell side momentum on the dollar, because of course the NFP figure did drive the dollar to the upside, as you can see here, with that presenting a more hawkish picture. But now we're starting to hear certain Fed officials kind of calm the markets in regards to we're still expecting to cut rates. We could definitely see price make its way back down into this previous range that we saw price in for quite some time. So definitely these levels around here areas which price could definitely make its way into and continue ranging within. Of course, definitely keep your eyes out for that, but also keep your eyes on the fact that we are currently sitting on the 3820 level, and we are nearing the 50% Fibonacci level, which lines up with a key area of liquidity. So we're definitely not saying that there's no upside momentum or upside opportunities in the market at the moment for the dollar, but definitely after the more reassuring rhetoric from the Fed, we could still see a great deal of sell side momentum come into the dollar going into this week. So keep your eyes on the dollar for sure. Next to talk about though is Euro USD, which is slowly pushing to the upside. Not too much to say on it, of course, but we are getting some very interesting Euro data this week, as well as some very important US data. So Euro USD is going to be very volatile as we enter the new week. So look out for some key levels on the charts as we do start off this new week. Next to talk about though is pound yen. Last week we did continue the push higher, and now once again we're sitting at this all-time high and key liquidity and resistance level, which is also at the Fibonacci extension zone of the minus 27.2, and this obviously follows price reacting to the 6180 short-term Fibonacci retracement level after the more longer-term level of the 3820 and key liquidity zone down here. So price has continued to react to these key zones and is now on the move to the upside, and whilst we have seen price sell off from this area not too long ago, now that we've had this retracement, now we've had this return of momentum, now we've had investors kind of get back into the market, we could definitely see price continue to the upside and finally break above these all-time highs on pound yen, with price then of course being open to the opportunity of moving all the way up to that minus 27.2% Fibonacci level. So definitely keep your eyes on pound yen. Next to cover quickly is Bitcoin, which is now pushing higher. It does seem like the sell side momentum and volume that we did see following the SEC approving Bitcoin ETFs was a very short-term movement, and now that long-term bullish momentum that we had been seeing in the market before that decision is returning, and we're moving to the upside once again, nearly already at the levels of all-time highs that we did see during the SEC's decision. So definitely keep your eyes on Bitcoin, as we are seeing a great deal of bullish momentum for sure. Next to talk about though is gold, which is ranging around at the moment and not too much is happening, but we are getting some very important US data this week, especially in regards to US inflation. And that will be definitely pushing gold to the upside or downside. So keep your eyes on that data and keep your eyes on gold. Lastly, to talk about on the charts though is oil, which of course has been heavily affected recently by world tensions within the Middle East, and is currently sitting above that 6180 Fibonacci level and liquidity zone. So not too much to say on oil, but definitely keep your eyes on it nonetheless. That's all to talk about in the charts though. Lastly to talk about, of course, is the economic calendar, where we're getting a lot of very significant data this week, but we don't have too much time left, so we'll get through it quick. Firstly, we will be getting the UK's unemployment rate figure, followed by Eurozone and German economic sentiment figure. Moving to the US, we're getting the US inflation rate figure and the British inflation rate figure. So two very important inflation rate figures which will be pushing important markets one way or the other. Next to talk about is the Eurozone GDP growth rate figure, which will be followed by the Japanese GDP growth rate figure and then the British GDP growth rate figure. So lots of GDP growth rate figures. Next, we'll be getting the Aussie unemployment rate figure, so a very important one in regards to the Aussie kind of pairs and that kind of thing. And lastly, for the US, we'll be getting US retail sales data and producer price inflation figure, followed by the US consumer sentiment figure as well. That's all to talk about on the economic calendar, though we've covered lots on the articles, lots on the charts, and lots on the economic calendar. Hope you have a great trading day, but that's all from us at Wildwood Capital. Have a great one. See you later. Bye.